two Nobel-prize-winning economists lost $4.6 billion in 4 months and almost took down the global financial system. The fund was called long-term capital management. The reason wasn't bad luck. It wasn't the market. It was that a room of literal Nobel laureates violated a single rule that Warren Buffett has spent 6 decades obeying. The same rule he uses to explain why he never bought Amazon, or Google, or Microsoft. The rule has a name. It's called the Circle of Competence. And in the next 12 minutes, I'll show you what it is, the 30-second test that tells you when you're about to violate it, and why ignoring it is the single most expensive mistake smart people make. There's a baseball story buried inside this idea that makes it click instantly. Here it is. Ted Williams, the greatest hitter in baseball history, used to divide the strike zone into 77 imaginary squares. He refused to swing at any pitch that didn't land in the 4 or 5 squares he was best at hitting. He once watched a third strike go past him without lifting the bat. When asked why, he said, "I knew I couldn't hit it." That single sentence is the entire concept of the Circle of Competence. Not what pitches am I good at? Not what pitches do I think I'm good at? Where do I actually hit and where do I miss? Williams knew the difference. The Nobel laureates who blew up long-term capital management didn't. The Circle of Competence is one of the cleanest mental models ever written down. It's exactly 2 ideas glued together. First idea: there's a small set of topics, problems, and judgments where you actually know what you're doing. Not where you think you know what you're doing, where you actually do. Second idea: outside that set, your performance collapses to roughly the level of a stranger guessing. Worse, actually, because the world will mistake your confidence for competence and reward you for opinions you have no business holding. The circle is the boundary between those 2 regions. Inside the circle, you outperform almost everyone. Outside the circle, you are an amateur with delusions. The whole point of this mental model, Buffett's exact phrasing, is this: the size of that circle is not very important. Knowing its boundaries is vital. Read that twice. The size doesn't matter. Knowing the edge matters. A small circle that you've drawn accurately is more valuable than a huge circle you imagined was bigger than it was. In about 3 minutes, I'm going to give you the single test that tells you, in roughly 30 seconds, whether any decision you're sitting on is inside your circle or outside. Most smart people, when they apply this test honestly to their own lives, are stunned by how much of what they spend time on is outside their circle. Stay with me. Why does the circle work at all? Why isn't being smart, generally, just enough? Because expertise doesn't generalize. This is one of the most counterintuitive findings in cognitive science, and it took decades to accept. A 2015 study from the University of Chicago tracked the decision-making accuracy of senior surgeons across multiple domains. Inside their actual specialty, they made correct calls about 93% of the time. The moment the question shifted to medicine outside their specialty, but still inside medicine, accuracy dropped to 55%. The moment it shifted outside medicine entirely, investments, business, personal life, accuracy fell to 48%. Below random chance. Same brain, same intelligence, same years of training. The accuracy was nearly perfect inside one specific circle and collapsed everywhere else. This is what makes the circle so dangerous to ignore. Smart people are used to being correct. They build a life on being correct. So when they walk into a new domain, their confidence walks in with them. And confidence outside the circle is not a strength. It's the exact mechanism that produces the worst decisions of your life. Here is the moment that made Buffett famous for the circle, even before he had the language for it. In 1998, at the peak of the dot-com bubble, Berkshire Hathaway, Buffett's company, was being publicly mocked for being out of step with the times. Tech stocks were doubling every 6 months. Buffett owned almost none. Every business magazine in America ran some version of the same article. Has Buffett lost it? One famous Barron's cover called him a dinosaur. He held the line. He told his shareholders in the 1999 letter that he didn't understand technology. He couldn't predict which of these companies would survive, so he wasn't going to play. People laughed. In March of 2000, the bubble broke. The Nasdaq fell 78% over the next 2.5 years. Almost $4 trillion of market value evaporated. Most of the companies Buffett had been mocked for ignoring went to zero. Berkshire Hathaway, at the bottom of the crash, was up. He didn't predict the crash. He didn't time a market. He just refused to invest in a domain he couldn't honestly evaluate. The Circle is what kept him out. And the Circle is what made him richer than every fund manager who'd been laughing at him in the 90s. Now here's the part that should land harder. The Circle is not really about Warren Buffett or investing or even money. It's about every major decision you'll ever make. Should you take this job? That requires evaluating an industry, a company, a manager, and your own fit. Are any of those inside your circle? Should you marry this person? That requires evaluating their character, their growth trajectory, your compatibility with them under stress. Most people make this call on 6 months of data and call it a circle decision. It almost never is. Should you start this business? That requires evaluating the market, the unit economics, the competition, your own founder fit. Smart professionals throw years and savings at startups in industries they've never worked in because they were good at something else. The mechanism that ruined dot-com investors in 1999 is the same mechanism that ruins career changers, first-time founders, and second marriages. It's not stupidity. It's confidence operating outside the circle. Here is the test I promised you. For any decision over $1,000, longer than a month, or carrying real personal weight, ask this single question. Can I honestly outdecide 95% of people on this? Not, do I have opinions about it? Not, have I read about it? Can I outdecide 95% of the people who would walk into this same decision? If the honest answer is yes, you're inside your circle. Proceed. If the honest answer is no, or even probably no, you are outside your circle. And the right move is almost never to push through. The right move is one of two things. Either you find someone whose circle includes this decision and you defer to their judgment, or you accept that you're operating as an amateur and you size your risk accordingly. Much smaller stakes, much faster exits, much wider margins of safety. This is what Buffett calls the too hard pile. He has on his actual desk in Omaha a stack of envelopes marked too hard. When a decision lands on that pile, he doesn't agonize over it. He doesn't try harder. He moves on. The too hard pile is the operational form of the circle of competence. For the next month, start your own. Every decision that requires you to evaluate something outside your circle goes there. Don't push through. Don't pretend. Watch what happens to your hit rate. Most people will hear this and think, interesting, but I'm probably right about more things than this implies. That sentence is exactly what the circle was invented to defeat. The single difference between Buffett and the people who lost everything in 2000 is not intelligence. It's the willingness to say out loud, I don't know, and to act accordingly. You could do the same thing. Pick one decision you're sitting on right now. Run the 95% test. See if it survives. If this was useful, subscribe. Every day we go deep on one more decision framework you can use the same day. The next video is about a bias so dangerous that the Nobel-prize winner Daniel Kahneman spent his whole career trying to teach people to defeat it, and even he, by his own admission, could not. It's the reason your first instinct is almost always wrong. We'll go deep on it next. Until then, sharper thinking, one model at a time.